Hey guys, it's Mike with Financeable here. It's Friday, which means it's time to answer the weekly challenge question. By the way, if you like these videos, definitely hit the like button down below and subscribe. We've got a lot more coming. Let's hop in here. All right, for this week's question, we have a puzzle question, but we've really dialed the difficulty up a notch. The question is, we have a company that has $20 of D&A, a 20% tax rate, $35 in cash flows from operations or CFO, $500 of debt at a 5% interest rate, 0 cash, and equity value of $250. The company trades at 10 times EV to EBITDA, and the question is, what's the change in net working capital? Let's dive in here and take a look. Two things before we kick it off here. First, on the bottom right of the screen, I've got a little preview of the income statement and cash flow statement, just so you can kind of see the numbers coming together as we work through them. And second, with all these puzzle questions, we want to start with the end in mind. In this case, we need to come up with a change in net working capital. To do that, if we look at the cash flow statement, we need net income, D&A, and cash flows from operations. Well, we've got D&A, and we've got cash flows from operations, so what we really need here is net income. So really this whole exercise is working the net income, plugging it in here, and then ultimately solving for the change in net working capital. So that's the exercise we're going to go through here. Let's walk through this step by step now. So we're going to start by calculating enterprise value. We have equity value of $250. We have debt of $500 and 0 cash. So enterprise value is $750. Once we have enterprise value, we can use the EV to EBITDA multiple to calculate the EBITDA. So we have enterprise value of $750, an EV to EBITDA multiple of 10 times, which gets us to an implied EBITDA of $75. And from EBITDA, we can work to EBIT with the D&A that we were given. So we have 75 of EBITDA. We have 20 of D&A that was actually given in the prompt. And then down below, we have our interest expense, which will get us to profit before tax. To get that, we're going to pull debt in from the first part of this exercise. We were told that we have a 5% rate on the debt. And so we can multiply the debt times the interest rate to get to our interest expense. And with our interest expense, we can work to earnings before tax or profit before tax, which is basically just our taxable income. So we'll grab our EBIT from up above. We'll subtract the interest expense that we had in the prior step. We'll sum this up, and that'll get us earnings before tax, which again is just our taxable income. We'll pull our taxable income up into step 6 and use that to calculate to net income by subtracting taxes. So we were told we have a 20% tax rate. So we'll take the EBT up above times negative 0.2 to calculate out our taxes. And that can be used to get us down to net income. And now we have net income. So now that we have net income, we can work to the answer. If you look down below, we have net income, we have D&A, and we have cash flows from operations from the prompt. And we basically have to take CFO, or cash flows from operations, and subtract out net income and D&A to get to the change in net working capital. So let's do that. So we have $35 of cash flows from operations in the prompt. We have our D&A over in step 3 we can pull in. We can take the negative of our net income in step 6 and sum all this up, and we get to -9. So the answer to this week's question was the change in net working capital is -9. As always, thank you so much for taking the time to check out our videos and for participating on the polls on LinkedIn that create these videos. If you found this video helpful, definitely hit the like button down below and subscribe. We've got a lot more coming. Hope you have a nice weekend. Take care.